On behalf of Crosscheck Media and Biz Talk Today TV, welcome everyone to The Money Path. I am your host, Todd Schoenberger. Joining me today is Rob Haworth. He is the Senior Investment Strategist at U.S. Bank. Rob, welcome back to the program. We have to talk about this market. S&P at a record high. We're actually on Dow 50,000 watch right now. Truly epic considering that we're in the middle of a war. So the question is Wall Street front-running perfection at this point?
Well, it's certainly helpful that we're getting to some signs that we're going to get to a close in the conflict and getting oil prices back under $100 a barrel, right? I think that's what the market is really hoping for here, is that we can get these oil prices down. We can avoid inflation kind of running rampant through the economy. And we're actually seeing that expressed in some other places today. It's been a great story in the U.S. market, but non-U.S. markets are doing much better as well because they've been much harder hit by these higher oil prices.
So U.S. Bank recently said that fundamentals are really continuing to be the octane for this market rally. But at what point do you think the fundamentals might become the market risk? And because there's so many other variables that are out there.
Well, there are always a lot of variables out there. I think the impressive thing to us is how first quarter earnings season is rounding out. More beats across the board, whether it's relative to early earnings growth expectations or revenue growth expectations. And then you look at where analysts are taking their full year expectations, they're ramping those up. And what we're hearing from companies is still very good news. You're not seeing a lot of misses. You're not seeing a lot of people have to take down their expectations. So we're in a very solid market. And that all goes back to two things. One, capital spending, right? Artificial intelligence continues to be a massive investment story, not just for the hyperscalers and the semiconductors, but through the data center infrastructure, through the energy infrastructure, right? We need to build out this archetype and ecosystem to support artificial intelligence. But two, the consumer has been quite resilient. Yes, it's been led by that high income, high net worth consumer, according to reports from the credit card companies, from the finance companies, from the airlines, but it's still a resilient consumer. And Friday's jobs report will be really important for this to tell us the story about, do they still have jobs, which we think they do. That's been a very positive story so far this year. But those two things are really helping these fundamentals stay constructive in this market.
So are you of the belief with AI that AI is going to be a job killer? Because everything we're seeing right now is that it's a job creator. And like you mentioned, it's that second derivative that's there when it comes to AI infrastructure. Plus, you also have the cybersecurity element that I don't think a lot of Wall Street traders are even anticipating yet. So do you think we might see job losses or job creation?
Well, I think on net, it's job creativity as we press forward. I think for many, it is a job loss in the short term, right? Some things that we were doing, we don't need to do. Much with the automobile and horses back in the day, right? You didn't need buggy whip manufacturers, but you needed a lot more things to support those automobiles. That's going to be true today as well. So it may be a rotation, but I think on net, right, productivity growth is an economic creator and a job creator. So that's what we think we'll get from AI through time. But it may be a rough ride. I don't want to dismiss that it'll be a rough ride for some employees, but on balance, there should be more growth here and better growth.
Okay. So are you seeing broadening leadership with this market rally, or are we now starting to concentrate dangerously again just in one sector?
Well, the leadership for the U.S. has certainly been technology, AI, as we've looked at the full year, right? It was a rough start to the year. Software companies in particular had a really rough start to the year. They started to catch up, but we are seeing this broaden out, right? Utilities have been participating. We're seeing industrial names start to do better, right? We're seeing good performance here in the market. And today in particular, you're seeing those foreign names start to pick up as well, which tells us that story of broader economic benefits as these oil prices come down, as the economy continues to grow.
How does US Bank differentiate between sustainable AI revenues to maybe speculative investing?
Yeah, I think that's a really fair question. Really, right there, the early start is investment, right? And what we're seeing from the hyperscalers is that is sustainable, right? It's not name for name's sake, right? We're seeing these Mag Seven, these Magnificent Seven companies have real investment and real money behind their products, and they're being sold, right? I think the next phase is we do need to see more return on that artificial intelligence. So this is where the proof does come down into the pudding. And we saw some of this differentiation in the earnings reports between, say, Meta and Microsoft, where Meta had a bit of a rough go. People weren't quite sure how they were getting paid out of this just yet. But there's more room to run, we'd say, across the whole cycle. I think then the next phase, not only for return on an AI investment for the creators, is the users. And for that, we're starting to look into certain sectors of the healthcare space where healthcare has not had a great year so far. It's been rough. It's one of the negatives for the sector. But if you look at the technology names, some of the insurance names, you're starting to see use there. And I think that's really important to tell the story of AI over the next couple of years is, are we seeing use cases be borne out in companies that turn it into revenue?
Let's turn the page to the Fed. Now you have new leadership with the Fed. Jerome Powell's gone, Kevin Warsh in. So going forward, though, it seems that the narrative is that the Fed cannot cut rates because of elevated oil prices. However, if the war ends, we all know oil prices are not going to be coming down anytime soon, but there's still the wild card about the labor market. What is your stance or US Bank stance when it comes to potential Fed rate cuts later this year?
Yeah, we're cautiously optimistic we can get a cut by the end of the year. I think it very much depends on how does this data evolve, right? Solid jobs reports and modest inflation means the Fed has some room. But I think the other question we have to get answered by the presumptive chair Warsh, who's I think he'll move through the Senate next week, um, is what is he doing with the balance sheet, and how does the balance sheet and interest rates really start to interact? So if he starts to shrink the balance sheet significantly, is that giving him room or impetus to cut rates in spite of inflation and a solid jobs market? So we'll have to watch that interplay as well, where we could get lower rates but a lot smaller balance sheet from the Federal Reserve. But for now, our base case is one cut, and we really need to see how the data evolves. And that's what we heard from three of the three dissenters, really, from the Fed meeting, from the last Fed meeting, was they really wanted to see how the data evolved, right? They really wanted a little more proof that inflation was not accelerating or that the labor market was fairly solid before they started making more adjustments.
And one of the key clues that helps the Fed is the monthly jobs picture. You brought it up earlier. So, what is your outlook for Friday's jobs report?
Yeah, we'll be along with consensus. We think it's going to be fairly constructive, right? Certainly, an ADP report that we heard recently tells us that private payrolls are doing better. We had a nice rebound in March. We had a lot of weather-related challenges in January and February. April was a fairly benign month when it came to weather. So we think we could see some positive stories here as we move in the labor report. The second thing we'll really focus on is wage growth. That's really important in this inflationary environment. We heard from the personal income report, wage growth was about 4.1%. We'll want to see those average hourly earnings continue to grow to let those consumers continue to spend, which is some of what we've seen from the weekly retail sales report and things like that. The consumer is still spending, and we'll want to see that they're getting that support from wages to continue to do that.
Let's turn to the Iran war. The big news of the day is from Axios, who said that the U.S. is very close to working out a deal, at least have a one-page memorandum of understanding for a potential peace deal with Iran. If that does not happen, because the White House in the last couple of hours has actually backpedaled from the optimism here. But if it doesn't happen, and we do have a flare up with hostility and the violence, and then oil prices spike higher, are you at all concerned with higher oil prices? Is there a price point for, say, Brent crude oil that could really derail this bull market?
It's probably time more than price. And so for us, the way we're thinking about it is from the One Big Beautiful Bill Act, we've gotten a lot of stimulus from tax refunds for the consumer. And kind of the economy is using that refund up, using that lift up in time through higher oil prices, meaning it's absorbing kind of that benefit that accrued to consumers. We think that runs out about mid-June. So if we're still seeing oil prices on West Texas Intermediate above $90 a barrel when we get into mid-June, then we're starting to run out of the grace that the One Big Beautiful Bill Act gave us in terms of consumer stimulus. And that's where I think it gets more challenging for the consumer and the economy is as we get out into mid-June. That's some of really what we're watching here.
That's fantastic. That's a great answer because nobody out there is giving a specific time frame or even a price for that matter. So I applaud you for taking a stance. So mid-June, we'll have our eyes on that date. We'll see what happens. With the higher oil or higher gas prices at the pump, that does impact consumer confidence and therefore retail spending. What do you think, though? U.S. Bank has been very upfront about how the American consumer continues to be resilient despite tariffs, but despite the higher energy prices. But like you said, mid-June is the time frame here. I mean, going forward, though, the American consumer still continues to be resilient, continues to spend. How's that happening? I mean, is it increasing credit or what are your thoughts there? Because there seems to be a disconnect between that the vulnerable consumer and a rising stock market.
Oh yeah, no, absolutely. And part of it is we've seen a significant disconnect over the last 3 years between confidence, right, what the consumer says and what they do. They've been very frustrated. They've not done anything different. They've continued to spend. Why have they continued to spend? One, they have jobs, right? A 4.3% unemployment rate is still quite low when we look at history. Two, they have rising incomes. As we pointed out, wage growth at 4.1%. So they're doing very well. So they have room to spend. Yes, credit is up, but it's not growing at an unsustainable rate, right? We're actually seeing that credit surge start to roll over, and it's because they have jobs, because they have wage growth, they can continue to spend money. What we would worry about and what we're watching every week is weekly jobless claims. If we start to see people not have jobs, that's where we really start to worry about can this consumer resilience be sustained? But for now, right, they can be frustrated, but as long as they have a job and an income, it looks like they're going to keep spending. And that's really what's driving that resilience is wages and labor and jobs. Sorry, jobs.
No, you're fine, but you're right though because the lower unemployment, obviously you have wage increases, but that's going to help really be the octane for further growth in the country. So, with all of that said, I mean, do you think going forward? I mean, I don't know. I mean, it just how important is diversification now? I mean, because it seems like large cap growth stocks continue to dominate. I mean, when it comes to portfolio construction, what's your opinion? I mean, should we still be focused on small caps and maybe treasuries at this point?
Diversification is still really very important, and we'd highlight a couple of things here. So one, compared to a decade ago, you are getting much more income from your bond portfolio than ever, right? So investors can actually slide down that efficient frontier, take on less risk, and still achieve their financial goals because we're getting much higher incomes. Two, we'd look for more diversification. If we are getting lower oil prices, that means that foreign central banks, like the European Central Bank, Bank of England, don't need to hike rates the way we're seeing priced into expectations right now. That's better for those consumers. The consumers there may be more resilient than anticipated at this point. And then here domestically, we think there have to be more winners, not just AI, right? And as long as the economy is holding in, right, we need more more investment in all sectors to build out this AI infrastructure and see more beneficiaries. So we think diversification makes a ton of sense, right? One, thinking about your fixed income exposure, looking for some interesting elements there. Two, getting some global diversification because it looks like foreign economies are going to hold up fairly well. And three, make sure your sectors are diversified here in the US because it's not just technology that's the winner in this economy, right? We're seeing that from energy investment. We're seeing that in utilities. We're seeing that in industrial names that are required to build out these data centers and artificial intelligence structures. So lots of winners to look for in this economy. And as long as that consumer remains stable, right, that provides a nice lift and a base for that AI investment to really pay off.
In your opinion, what's the biggest market risk investors are not paying enough attention to right now?
Well, I think they're paying attention to quite a few things, right? There are plenty of market risks that we'd probably set aside, right? Midterm elections, lots of worries. It's all about the economy, right? That's really what it's all about. Geopolitical conflict, it looks like we're getting through that. We'll have to see how that works out. So for now, I think we're doing okay, right? People could worry about valuations. The challenge we go back to is earnings are really fairly strongly supported. For us, when we think about risks, we're probably more focused on what our market price is telling us. We're going to start to worry if we get 10-year treasury yields north of 475, right? That tells us maybe we're starting to worry about our debt risk here in the US. We're going to worry if markets start to fall apart and start to get down below that 10% level. That tells us earnings are maybe not as sustainable. So for now, we're gonna stay constructive because that's really the story. We're going to watch some of these risks, but the market is going to tell us when they're really becoming problematic.
What's final question? What's the one macro signal a US bank investor should watch every day?
Well, today it's a good question, Todd, because I actually mentioned this to the advisors on a Monday morning call. The first thing I'm looking at every morning right now is oil prices. That tells me something about what's happened overnight right away without even looking at the headlines. Over the longer term, I would be looking at where 10-year Treasury yields headed. I want to understand what's going on with inflation and growth, and the 10-year Treasury is a very good way to do that. So those are the two things that once we get out of crisis and the center of the story is not oil, I would turn to 10-year Treasury yield. Today, it starts with oil.
So do you think though that the 10-year treasury yield that could be that's the most important market trigger right now?
Not the most part market trigger, but it is the most important signal, meaning it's telling us what are investors really thinking, right? As we were getting up above 4.4%, right, that told you about the stress about inflation. It told you about the stress about the debt situation, as we have a lot of money we need to pay now to rebuild our stockpiles of weaponry and missiles and other things.
Okay.
As it was getting lower, right? And today we're seeing 10-year Treasury yield move lower. That's taking some of that inflation risk off the table. That maybe opens up what the Federal Reserve can do, right? It creates a little less stress in the system if we're seeing that 10-year Treasury yield come lower.
Final question. Does that cause a concern? Is there a signal there? Because when you see yields dropping, you obviously bond prices going up, but you have a rising stock market. I mean, doesn't always work that way. Is there some correlation here that we should probably keep an eye on?
Well, well, yeah. The interesting thing is when we look at correlations over the last 3 years, stocks and bonds have been highly correlated, meaning when stock prices are going up, you're also making money on your bonds. That's a little more unusual, right? What you hope for from a diversification perspective is if stocks are going down, that's when you're making money on your bonds. If stocks are going up, it's okay for bond yields to stay steady. Maybe they can rise a little bit, hurt you, right? That's okay. And so today, I think we're seeing a little more normalization, right? We have to pay attention to that correlation factor of you want your bonds to be diversifiers when it comes to U.S. Treasuries. That's been maybe more of a challenge over the last year and a half that your Treasuries have not been providing as much diversification. What it's led us to do is look for more income and other elements of the market where there's maybe different safety. So things like structured credit, maybe non-agency residential mortgage-backed securities, where you're picking up a little extra yield, but you have a lot of home equity built into those mortgages. So you're able to get a little extra yield and you're being backed up by housing that's fairly highly appreciated, fairly stable, and fairly attractive. So getting some more diversification in your bond portfolio is really helping that stock bond diversification in a way that we haven't seen lately between treasuries and stocks.
It's beautiful. It sounds like a great portfolio to me. That's awesome. Rob, I
Thanks so
want to
much,
thank
Todd.
Absolutely. Rob, I want to thank you for joining me today. I know you're very busy and you have a lot going on, especially with the rising market today, but I do appreciate you taking the time and I can't wait to have you back.
Look forward to it, Todd. Thank you so much.
Absolutely. So on behalf of Rob Haworth, I am Todd Schoenberger. Thank you once again for joining us on the Money Path. Coming up at 2:30 today, live, I'm sitting down with Michael Monahan. He's the founder of Founder ETFs. You definitely want to hear what he has to say. He has some interesting concepts about the markets. So until then, take care.
Access real-time data and intelligent analytics exactly when you need them. Get the right data at the right time. Learn more at quotemedia.com.